As the U.S. markets are currently closed, we are looking at the final closing data for Nuburu Inc., ticker symbol BURU, from Monday, November 17th, 2025. The stock closed at $0.2156 per share. That was a brutal session, finishing down $0.0332, a drop of 13.34% on the day. But the price isn't the real story here. The volume is. An absolutely staggering 46.39 million shares traded hands. To put that in perspective for a stock at this price level, that is a massive, massive wave of selling, or perhaps desperate hot potato trading, suggesting a fundamental breakdown in investor confidence. This isn't a quiet drift down. This was a stampede for the exits. And the immediate, unexpected reality behind this collapse is that Nuburu is a company in the midst of an existential crisis, a high-stakes pivot so dramatic that its original identity is almost unrecognizable. This 13% drop isn't just a bad day for a tech stock, it's the market screaming that it has deep, profound doubts about whether this company will even survive its own transformation. The common expectation for Nuburu, for anyone who's been watching it or perhaps seeing it pop up on a Robinhood app scanner, has always been centered on its name, Blue Laser Technology. It sounds futuristic, specialized, and exactly the kind of disruptive technology that could feed into major growth sectors like electric vehicles, 3D printing, and microelectronics. The narrative you were supposed to buy into was that Nuburu's proprietary tech could weld copper and other reflective metals far more efficiently than traditional infrared lasers, solving a key manufacturing problem for battery producers. It's a great story. It's the kind of story that gets a company through a SPAC merger and onto the NYSE American exchange. It's the kind of story that makes a retail trader, perhaps doing some self-investing on a platform like SoFi Invest, look at the 52-week high of nearly $1 and think that a 21-cent entry price is an absolute steal. The expectation is that you're buying a discounted technology leader, but the reality, the one that yesterday's 46 million shares of volume is reacting to, is that this company is, by its own admission, rapidly and desperately attempting to become something else entirely. The blue laser business, as it turns out, appears to be a financial black hole. Recent quarterly filings have been utterly devastating, showing revenue figures that are not just small, but in some cases effectively zero. We are talking about a publicly traded company with net losses in the millions of dollars per quarter while reporting revenue of nil. This isn't a slowdown, it's a full stop. The company is burning through cash at an alarming rate, a fact highlighted by multiple financing rounds and a $12 million public offering back in September, which has led to massive shareholder dilution. This is the reality that clashes so violently with the next-gen tech expectation. The original business model, for whatever reason, has failed to generate income. So, what does a company do when its core concept isn't working and it's facing delisting? It pivots. And Nuburu's pivot is one of the most aggressive and chaotic we've seen in the microcap space. In the last 60 days, the company has effectively announced it is no longer a laser company. It is now a defense technology acquisition vehicle. This isn't a subtle shift. We're talking about a flurry of press releases announcing strategic alliances, joint ventures, and acquisition plans. They announced a strategic alliance with Maddox Defense to create a joint venture focused on building military and commercial drones. They announced the first phase of an acquisition of Orbit SRL, an Italian company specializing in operational resilience software. Just last week, on November 12th, they announced a renewed partnership with Tecne, another Italian defense contractor, which involves Nuburu gaining exclusive distribution rights for Tecne products in the Americas, joint go-to-market strategies for NATO, and a massive €15 million financial commitment from Nuburu to strengthen Tecne. This is the tension that is tearing the stock apart. The market is looking at a company with almost no cash and zero revenue and hearing it promise to make a €15 million investment in an Italian defense company. Where is that capital coming from? More dilution, more toxic financing, more convertible notes. The 46 million shares traded yesterday represent investors who likely bought into that September offering or even earlier, finally reading these new press releases and realizing the dream of a pure-play laser tech stock is dead. Instead, they own a piece of a highly speculative, incredibly complex roll-up strategy in a completely different industry run by a management team that is juggling compliance issues. Let's not forget, just last month in October, Nuburu received a warning letter from the NYSE American Exchange. It wasn't about their financials, not directly, but about their corporate governance. They announced a dual CEO structure without properly notifying the exchange, a rookie mistake that screams of internal chaos. The company quickly resolved it, calling it an administrative delay. But for institutional investors, that's a gigantic red flag. It signals that the leadership might be in over their heads, which is terrifying when they are simultaneously trying to execute 3 complex international defense acquisitions. This is why comparing Nuburu to something like Apple stock or Tesla stock is a category error. Those are established enterprises. This is a microcap gamble. This is the kind of stock that many serious Fidelity Wealth Management advisors or Schwab Intelligent Portfolios would automatically filter out. It's purely in the realm of speculative online investing. Even on platforms that cater to active traders like Interactive Brokers, the data is stark. You can see the cash burn, the negative profit margins, the dilution. This isn't investing. It's a bet on a turnaround story so convoluted it's hard to follow. The 13% drop yesterday is the market trying to price in the monumental risk that this entire defense pivot is a house of cards, funded by hope and future offerings that will dilute the stock into oblivion. Looking at this pivot, I have to ask, do you think Nuburu's shift into defense is a brilliant last-ditch effort to build a real business from the ashes of the laser idea? Or is it just rearranging deck chairs on a sinking ship? Comment below with your take on this defense transformation. Let's briefly revisit that original promise because it's important to understand what was lost. The science was compelling. Nuburu's blue lasers operate at a wavelength that is much more readily absorbed by metals like copper, gold, and aluminum. For an industry like EV battery manufacturing, which requires welding thousands of copper or aluminum foils together, this technology promised spatter-free welds, higher quality, and faster production. It had applications in 3D printing, allowing for the printing of pure copper parts, which is notoriously difficult. This was the expectation. It was a beautiful, clean, high-growth narrative, but the reality is that they couldn't sell it. Whether the tech wasn't ready, was too expensive, or simply out-marketed, the financials tell the truth. It failed to launch. And so, management was left with a publicly traded shell and a stock ticker, which they are now using as currency to buy their way into a completely different sector. So, what is the future outlook here? This is where the expectation versus reality framework becomes critical for anyone still holding or considering a position, perhaps in a Fidelity brokerage account or a SoFi trading platform. The bull case, the new expectation, is that this gamble works, that the dual CEO structure, despite its rocky start, manages to close these acquisitions. The $15 million commitment to Techne is meant by some new financing. The Maddox drone JV actually builds and sells drones. The Orbit software gets integrated. In this scenario, Nuburu successfully transforms itself from a zero-revenue laser company into a small but real defense contractor with multiple revenue streams. If they can pull that off and achieve, say, $50 million in annual revenue, the current market cap would be a joke, and the stock would fly. Now, for the reality. The bear case is far more probable. The company is burning cash it doesn't have. The 13.34% drop yesterday on 46 million shares suggests the market believes this case. The reality is that the company is likely to run out of cash before any of these acquisitions can become profitable. The $15 million commitment to Techne looks less like an investment and more like a liability it can't possibly meet. The NYSE American Exchange, already watching them for compliance, will be monitoring their financials and their low price range. Another bad quarter, another delayed filing, or a dip below the minimum price requirements for too long, and they will be delisted. If that happens, the stock becomes almost untradeable on major platforms. Liquidity vanishes and the entire roll-up strategy collapses. Yesterday's massive volume spike looks like capitulation. It looks like the smart participants in the recent offering decided to get out with 21 cents on the dollar rather than risk getting zero. In the end, the story of Nuburu is a harsh lesson in online investment. The expectation was a futuristic technology in a high-growth sector. The reality is a company with a failed core business, nightmarish financials, and a desperate, chaotic pivot into a completely new industry, all while fighting off compliance warnings. Yesterday's 13% crash wasn't a dip. It was a verdict.